How exactly is this money going to be spent? There are mixed views on South Africa receiving this loan from the IMF, with some saying that the global financial body will have control over the country. But what are the merits of this loan, and what are the conditions, if any? To help us unpack this loan and its pros and cons, I'm joined by economist and senior lecturer at the University of Johannesburg, Dr. Sean Muller. Dr. Muller, thank you so much for talking to us this evening. Are there any conditions attached here?
Good evening, and thanks for having me. There are not explicit conditions per se, at least not from my reading of the documents. The basic condition is the same kinds of conditions one would have with the bank from which you receive a loan, namely that there will be a certain interest rate on the loan, which is quite a favorable interest rate at about 1.1%, and then we'll need to pay the loan back after a period of time, and we'll pay it back over a period of time as well. So the terms, as I understand them, are that we'll have to pay back the loan over, I think it's 40 months, and that will start 20 months after the loan has been dispersed, and we'll pay a rate of about 1.1% on that loan, which is a lot less than the government is currently paying on its borrowing.
And some have raised concerns around, the sovereignty of South Africa here. Do you think we've placed our sovereignty at risk by approaching the IMF?
I don't think so, but I do think it's an important question to ask. The IMF and the World Bank don't have a very good record, in particular from the 1980s and 1990s, in terms of how they used countries' fiscal situations in order to impose what were basically an ideological set of policies known as structural adjustment on developing countries. And those policies did a lot of harm. The IMF has come close to acknowledging that a number of those policies were misguided. Now, times have changed to some extent, and the IMF, for example, not that long ago, recognized, for example, the harm that inequality causes to economic growth, which was something that sort of left-wing economists had raised for many decades, and the IMF had denied. So we have moved on a bit. But I think in the context of this loan, although the IMF does indicate in the loan documents that it does expect the National Treasury to implement what have been called structural reforms, it's important to emphasize that the National Treasury is actually the institution that's been wanting to implement those. And the IMF is really just saying that it buys into that commitment. But ultimately, our main obligation is going to be to repay the debt. And I think the conversation, when it comes to, so I don't think there's a particular sovereignty risk at this point, and I think it's very unlikely that we wouldn't be able to repay this loan. It's important to remember, at least my understanding of public finance legislation, is that we're actually obliged to repay creditors before we can get to spending on other government items. And although 70 billion rand is quite a lot of money, it's not that much when you think about it in the context of a budget that's, at least previously was, close to 1.4 trillion. So we should have the money to pay it back, even if the economy is doing really badly. And in that sense, it's not going to compromise our sovereignty. I think the debate that perhaps we have to have is about these structural reforms that the Treasury has been proposing. And for myself, I have a number of concerns about those. But the concern then is with the Treasury and the endorsement of the Treasury's proposals, rather than actually being a concern with the IMF.
And let's then look at those structural reforms. One of them is around the public sector wage bill, a hot potato that has been going on for quite some time now. But South Africa is finding itself in a catch-22 situation here, where you've got this, what the minister, the finance minister, has said is a bloated public wage sector bill. And you're also seeing, the unions that are calling for an increase in that particular sector. But then if you do cut that public sector wage bill, you are then throwing a lot more people into the unemployment line. How then do we navigate these waters?
Right. I think that's a very important question. There are a bunch of other structural reforms the Treasury has proposed as well. Like it wants to introduce an economic regulator into the transport sector, which I and some others think is a really bad idea. But focusing on the public sector wage bill, I think what we really need to start doing is getting into the nuance of these questions, as you're suggesting. So, if you cut the public sector wage bill, are you cutting the number of public servants, or are you cutting salaries, for example? I don't think it's in part, it's correct to say that we have a bloated public sector, certainly because there are certain bureaucratic areas of employment which are bloated. There are people who are not working efficiently, who arguably are not necessary, and they may well be overpaid. But the thing is, there are other parts of the public sector that are horribly under-resourced. We know that our hospitals don't have enough resources, and that's been exposed really badly by this pandemic. There aren't enough teachers, and we see that reflected in class size. We don't have enough social workers, for example, and community workers. So there are lots of areas of the public service that are really not adequately staffed. But it's true that there are some parts of the public service that are bloated. But it means that we can't just talk simplistically about a bloated public sector wage bill. What we can say is that maybe the public sector wage bill is higher than we can sustain right now. But what we do about that, I think, depends on how we understand that problem. And so, for example, you could, and I'm just giving this as an example, you could, for example, fire 10,000 excessively paid and unnecessary bureaucrats, and you could hire 30,000 frontline workers, and you could still actually reduce the wage bill because those frontline workers might, for example, be paid 200,000 rand a year, whereas the bureaucrats were paid maybe 800,000 rand or a million. So, another way of approaching this is also to think about how we structure the public service. But certainly we're going to need some kind of agreement between the unions and the government, and that's what people are referring to when they talk about a social compact. We have to agree on a way forward. We're not going to get anywhere if this becomes a conflict between the public sector trade unions and the government.
And some people have raised concerns around this time that we may find ourselves heading for a fiscal cliff. Do you agree?
Well, the one thing I want to say is that the concept of the fiscal cliff and the way it's used in South Africa is really not very credible. It comes from a particular paper that was done a few years back, and which was alarmist and methodologically flawed. So the basic question that people normally talk about in the public finance literature is about debt sustainability. Is our overall debt and the deficit we have every year, the difference between government spending and government revenue, is that sustainable? And certainly, there were concerns about that before the COVID-19 pandemic. Debt had been escalating beyond the National Treasury's targets every year, and what was of particular concern was that economic growth wasn't increasing. You see, the thing is that debt is not a bad thing on its own, provided it's accompanied by growth and increased economic growth and increased revenue collection. The problem we face as a country is that debt has been increasing significantly, our total debt relative to the size of the economy, but the economy hasn't been growing faster, and revenue collection has continually been underperforming. Now with the pandemic and the dramatic drop in economic growth and the decline in revenue collection, debt has increased and is going to increase quite dramatically. Government has also needed to spend a little bit more on healthcare and so forth. So we're certainly heading into a situation where we're at greater risk of a fiscal crisis, of a crisis for public finances. And that's what we really need to worry about. And that's the Treasury's main concern. It's actually their main constitutional obligation, is to make sure that we don't, that our public finances are stable. And as debt increases, regardless of what you think the appropriate level of debt is, and economists and other commentators debate this all the time, but the one thing that we can say for sure is that as debt rises without a corresponding increase in economic growth, we're at greater risk of a fiscal crisis. And if we have a fiscal crisis, that will have even more devastating effects on the lives of ordinary people.
And the finance minister recently said that we may, we do have the option of approaching the World Bank here, and looking at the fact that we've already secured 5 billion rand from the African Development Bank, and the new development bank as well, making available to us $1 billion US. Would this be a good idea at the back of the IMF loan to then look into the World Bank if we have to?
Sure. So I think the important thing is to say that with the special adjustments budget that the minister tabled and the 500 billion rand package, the Treasury indicated that they were intending to raise 95 billion rand from international financial institutions, which includes the IMF, the World Bank, the African Development Bank, and the BRICS New Development Bank. So what's happened thus far is in line with that. At that point, we didn't know what the different amounts were going to be from these different institutions. But thus far, the amounts that you're talking about, added to the IMF loan, suggest that we're on track for what the Treasury said was going to happen. For myself, I think if the terms of those loans are reasonably favorable, which currently seems to be the case, then it's perfectly sensible to take that money. Because, you see, the thing is that the government is wanting to borrow this money because of the plans, the spending plans and the revenue-raising plans that it presented to Parliament with the Special Adjustments Budget and which have been approved by Parliament by and large. It's still processing some of the legislation. So the fact is the Treasury made those proposals about spending, about borrowing and revenue and so forth. Parliament accepted them, which essentially means that as a country we have accepted them, and that means that we need to finance those proposals. So if we didn't take this money from the IMF or the World Bank and the African Development Bank and so forth, we'd have to borrow it on the normal open market. And the thing is that with South Africa's downgrade to so-called junk status, our borrowing costs have increased. They were already increasing prior to that. But basically the terms on which we borrow in international financial markets and in local financial markets, in fact, have worsened. So if we can get financing at relatively favorable rates without compromising our policy sovereignty, then we should do it.
Well, Dr. Muller, thank you so much for your time tonight. It does look like there's very interesting views that will continue to come out when it comes to this particular subject around the IMF having granted South Africa that 70 billion rand loan.